All right, everyone. Welcome back to another Cryptopolitan Weekly Market Recap. It's time, folks. It's time to ask some of those difficult questions and listen to some of the harshest realities that the data is showing us. If you were active in the market last week, you didn't just see red candles, you actually felt it. It wasn't a normal pullback by any means. It definitely felt like a sort of reset. Liquidations rose, sentiment, absolutely tanked, and fear readings dropped to levels we haven't seen since forever. Now, this is true in the data. If we go ahead and look at the fear and greed index, today it's at a reading of 5. We have never been this low since its inception. And, whenever there is this kind of emotional whiplash, it's really important to take a pause because panic can be loud at this point in time and the data can actually be quite, muffled. But last week, undeniably changed the short term structure for Bitcoin and the broader crypto market. We, in fact, discussed last week about the key levels that gave way. So, naturally, the conversation sort of changes now. Uh, we have to start by asking the question, and a little bit of an uncomfortable question: how low can Bitcoin actually go from here? That's what we're going to be breaking down today. We're going to look at the data that's actually in front of us. We'll start with historical drawdowns. How does this correction compare to previous mid-cycle pullbacks? Are we still within the normal territory of the 4-year cycle? Then, of course, we'll go ahead and look at some on-chain stats and positioning. Is there genuine capitulation beneath the surface? These are the type of questions that we will be tackling today. Now, without a doubt, what we witnessed last week was a deep, deep drawdown. And it has definitely shifted the structure. And, there were billions wiped out in days, uh, sentiment falling off a cliff. That's the market essentially repricing risk. Right now, we're clearly in that unwinding phase. And the difference between a healthy correction and something deeper usually comes down to structure and positioning. That's why I believe zooming out is so, so important right now. A violent week like last week can, distort perspective. And when you see, double digit drawdowns on your favorite altcoins, it triggers a sort of memory, right? It reminds people of prior collapses. But again, this is where context matters. I'm not going to hand you certainty in this stream. Markets do not offer that. But I will give you a framework and a couple of signals to judge the probabilities from here. So, with that said, let's actually zoom out and put this drawdown into some sort of historical perspective because I think timelines really matter here. So before we even get into specific downside levels, let's take a step back and talk about timeline probabilities. Um, See, the thing is, when markets get this volatile, the first instinct is to just jump straight in um, and have your positions in, right? But before we anchor ourselves to any sort of level, we should be asking, when does Bitcoin historically bottom? It's very, very easy to chase prices when they're falling quickly. They might seem really attractive because, we were just at 126K and now look at us, we're at 60, 67K, right? And it's very easy to get blindsided by the fact that you might actually have time to average your position. You can dollar cost average your way down. And one way to approach that is by looking at these historical timelines. We have the benefit of this data, so why not use it? So, what's remarkable and honestly, I think a little ironic, is that at the start of this year, there was a lot of talk about the 4 year cycle being broken. We're entering a sort of 5 year cycle now. You probably remember it. This time is different. Institutions have changed everything. The halving doesn't matter anymore. That narrative was everywhere. But if you strip away the noise and just look at the data for what it is, so far this cycle has played out almost exactly like the previous ones. Now, if you measure the return from the cycle low and count how long it took Bitcoin to reach its peak in each of the last three cycles, the topping window is actually very, very close. So let's go ahead and just look at this. In this cycle, the peak came around 1054 days. Now, the previous cycle was around 1062 days. And the one before that was around 1066 days. So you see where I'm getting at. Despite ETFs, macro overlays, institutions, and everything else that has changed, the cyclical component of Bitcoin has continued to show up. So when I say that, the first thing I think is really simple. If the peak happened roughly when peaks tend to happen, maybe the low could also happen when lows have historically happened. So let's flip the script here. Let's look at the cycle performance from all-time highs to the cycle low. So in the last cycle, let's do the same sort of framework, right? In the last cycle, Bitcoin bottomed out around 378 days after setting its all-time high. And the one before that was around 363 days. Okay, again, you see the similarity there, right? Now, if we assume, and this is again just a probabilistic framework, that the cyclical rhythm continues, we can actually project that forward for this cycle. So right now, we are about 129 days from the October all-time high last year. If historical averages suggest a bottom roughly, let's say 370 days after the peak, that would imply we still have around 240 days left, right? So let's go over to the chart and let's map this out to see where that would land us, right? So let's take the date range and let's go down to 240 days from here, roughly. And that brings us to October of this year. Again, this is a probabilistic framework, but I also don't think it's random speculation, right? So Q4, bottoming out phase, according to this. What this implies is, it's important. Now, I'm not saying October is locked in. Markets do not care about our calendars, but it's worth noting that the last two cycles also had a clean yearly symmetry. One ran from November to November, and the cycle before that ran from December to December. So what I'm saying is that there's almost been this seasonal rhythm to how Bitcoin moves through its cycles. So the idea of another Q4 bottoming out phase, we cannot say that it's fully speculation, right? If the 4 year rhythm is still intact, and so far it appears to be, then from a time perspective, we may not yet be in the final low window, at least from a timeline perspective. Again, this is not a prediction, it's just a framework. Cycles can compress or extend slightly, but when you see this level of uh, historical symmetry take place across different cycles, I don't think you can ignore it. Uh, Now, with that, broader time-based perspective in mind, I think it's important to shift into the actual downside scenarios, and we'll start mapping it out with the first on-chain indicator, Bitcoin's realized price, which currently actually sits very close to the 200-week moving average. I'll come on to that as well. But firstly, we'll look at the realized price, and I'll explain to you what it basically is as well. So basically, the average price at which all Bitcoin was last bought or moved is known as the realized price. So instead of looking at the current market price, which is constantly jumping around, it asks a different question. On average, what did people actually pay for their coins? You can sort of think of it as the network's overall cost basis, and it gives us a rough idea of where the average holder is sitting, whether they're in profit, uh, at break even, or even underwater. And that matters because when price drops towards the realized price, the market is actually approaching the average break even level of all participants. And historically, that's where deep value starts to emerge. It's also where psychology shifts. When prices move towards or below that level, a large portion of the market moves from being in profit, and naturally that tends to change behavior. Right now, Bitcoin's realized price sits roughly at around 55K. Um, from current levels, that would imply around a 16% drop if price were to revisit it. Now, if we look at previous bear market lows, Bitcoin has consistently interacted with this region during its final capitulation phases. It's almost acted like a magnet during deep correction. But here's, I think, something very important to note. Bitcoin doesn't always just tag realized price and immediately sort of bounce off of it. In multiple cycles, price has actually dipped below realized price. So if we zoom in here, we can see the previous cycle as well. We dipped below and we reclaimed it eventually. But this happens time and time again, right? We go below the realized price and reclaim it and start and use this as support as well to eventually reach a bull market. So that's a very important point to recognize. And historically, if we take it on an average, those deviations have gone roughly 20 to 25% below realized price before actually stabilizing. So if we apply that same framework today and calculate a 25% drop below the current realized price of 55K, that would place Bitcoin somewhere in the 41 to 40K region. Yeah, that number doesn't look random. And this is actually where there is a little bit of a confluence that comes into play. Realized price isn't the only long-term structural indicator sitting in this region. We also have the 200-week moving average, which is currently at around 58K. And this has been a historically important zone for support as well. Now, in this region and in this last cycle, we didn't just see price neatly respect it just like the realized price. We actually saw a brief drop below the 200-week moving average, and let's just go and have a look at the chart. Right, in the previous cycle, Bitcoin dropped below this price, below the 200-week moving average, and went down roughly around 30%, right? Yeah, before ultimately recovering. So if we take today's 200-week moving average and again apply a similar 30% drawdown scenario, let's see what that would look like. Currently at 58K, so roughly 30% drawdown from there would imply 40K. So this is the confluence, right? This is the confluence that I'm seeing, that a lot of analysts are seeing, and you start to see the pattern. Historical deviation below realized price points towards 40K. A historical deviation below the 200-week moving average points towards 40K. These are two independent long-term indicators, different methodologies, but they say the zones are matching up. It's aligning, right? Now let's zoom out even further. If Bitcoin were to drop to 40K from the October all-time high, let's see how much of a correction that would be. So October all-time highs, a drop to 40K would imply a roughly 70% or 69% correction. I know that sounds unreal, but to remind you all, previous bear markets have been worse. And at first glance, I know that sounds extreme. The first major bear market saw a drawdown of roughly 94%. The one after saw 87%. The third cycle saw approximately 84, and the last one was 77. What you can tell here is that each cycle's drawdown has become progressively less severe. So if we actually extend that pattern of diminishing drawdowns, a roughly 70% decline from the peak to the lows, I don't think would be historically abnormal. And again, where does that 70% drawdown from the recent all-time high place us? Right around 40K. So now we have three separate frameworks pointing towards the same region. Now again, this is not a prediction that Bitcoin must go here. This is about mapping the probabilities. It's about identifying where downside scenarios sort of cluster or come together. Now it's important to say that price is only one side of the equation. The other side is behavior. A true bottoming out phase forms by how much of the supply is in profit versus loss, and how participants are reacting beneath the surface. And that actually brings us to the next indicator I want to highlight. It's the percentage in supply versus loss. Now, this one has been circulating around crypto Twitter quite a bit, and I think it's a very, very key indicator to actually, understand and also monitor as we go ahead. Okay, so at its core, the percent supply in profit is basically a pain gauge, right? When a very high percentage of coins are sitting in profit, that tells you the market is pretty comfortable. Most participants are winning here, right? And historically, when too many people are comfortable, downside risk actually increases because there's less force selling behind us. Now, on the flip side, when a large percentage of coins are at a loss or underwater, that's when real capitulation tends to form. That's when weak hands have already been wiped out, they've sold, and long-term holders begin quietly absorbing that supply. That's usually where the durable bottoms form. Now, historically, Bitcoin bottoms when a large chunk of supply is underwater, when long-term holders are stepping in, and when there's actual, seller exhaustion taking place. So, with that understanding, let's look at where we are today. Right now, Bitcoin is trading around 67K. The percentage of supply in loss, let's zoom in here so that everybody can see. The percentage in loss currently stands at around 8.6 BTC, whereas the percentage in profit remains at 11.3 million BTC, right? And if we look at it from a percentage standpoint, that is roughly 56.89 percentage, right? Now, the market definitely feels like it's in a capitulation mode. But when we compare these numbers to historical cycle bottoms, something important begins to actually stand out. At the 2022 bottom, supply in profit dropped to roughly 48%. So if you can see here, it's around 48%. Now in the 2018 bottom, this was around 42%. And the prior cycle was around 43 to 42%. Right now we're sitting at 57. That means we're still about 8 to 16 percentage points above historical bottoming zones. And that gap is where our downside probabilities come from. So the question now becomes, how much further does price typically need to fall to push this supply in profit down into that range? If we look at previous cycles, once supply and profit dropped into the 55 to 60% zone, which is roughly where we are now, there was usually additional downside before the final low, right? In 2018, after entering this mid capitulation zone, if you can call it that, Bitcoin saw another 20 to 30% drop before bottoming. In 2022, we saw something similar, roughly another 25% decline. So what that suggests is that we're not yet in that final capitulation area. Now let's actually translate that into probable price levels. With BTC at around 67K, we can model three potential downside scenarios based on how supply and profit has behaved in the past. The first scenario is what I'd call a soft bottom. This would look like a controlled correction where supply and profit drops towards around 50%, but doesn't fully collapse. Historically, that might require around a 10 to 15% decline from here, which would place Bitcoin somewhere around the, let's see, around the 57 to 56K mark. Again, very close to the 200-week moving average. And the second scenario is what history suggests is the most statistically common outcome. In that case, supply and profit would drop towards roughly 48%, which is marked the prior bottoms. To reach that level, we'd likely need another 20 to 25% downside from current levels. Now that would bring Bitcoin, let's take that, to around, between 50K and around 48K. So that's the second scenario. The third scenario is my bearish case. This is where supply and profit falls towards 41 to 43%, similar to the 2018 and 2015 cycles. To get there, we'd likely need a 30 to 35% drop from here. I know it sounds scary, which would bring price to, I believe, around 47 to 43K region. Yeah, around 43K. So these are the three possibilities based on this indicator, and perhaps levels we will have to revisit if there is a considerable sort of momentum shift around there. That said, I think the takeaway here is that the market already feels like capitulation. But the fact is, on-chain data suggests we're not at the complete bottom of the pain phase yet. Definitely, we are in a transition zone, but not the final capitulation level. Does that mean we must drop into the 50Ks or 40Ks? Absolutely not. But if we're mapping probabilities rather than reacting emotionally, the most likely path, based on the data that we have, would involve sweeping these ranges before forming that durable base. Now, before we wrap up the stream, I know it's been pretty gloomy out here. Uh, the charts haven't looked great. Sentiment has clearly taken a hit, and a lot of what we've discussed today revolves around downside probabilities. But I think in times like these, it's it's important to zoom out for a moment and also talk about what's happening in the space with regards to adoption. And I think firstly, we'll start with Ethereum. Right? ETH has been battered. It's below 2K. Ethereum staking, though, just climbed to a new all-time high. More than 30% of the total ETH supply is now staked. That's over 36 million ETH locked and close to a million validators securing the network. Think about that for a second. Even with price under this much pressure, more and more supply is being removed from circulation and locked into long-term staking. That tells you that a large portion of participants aren't reacting emotionally to these short-term price moves. They're committing capital to secure the network and actually earn yield over time. I don't think that's speculative behavior. And this actually ties into something broader because even though markets have been pretty bleak from a price perspective, institutional adoption in this space is showing no signs of slowing down. Absolutely no signs. And this past week, we saw developments involving Franklin Templeton and Binance around tokenized money funds being used as collateral. And let me simplify what that actually means. Basically, it says traditional asset managers are starting to use on-chain products inside real financial workflows, not just buying Bitcoin because it's trending, not just trading some sort of volatility, but actually integrating crypto infrastructure into how money is managed. Then the next bit of news that we saw was regarding Uniswap, right? So Uniswap had a major announcement with BlackRock, right? Let me actually pull up that tweet. There you go. Yeah. So Uniswap had this news come out. When a firm like BlackRock interacts with decentralized infrastructure or moves assets on chain, it's rarely random. Institutions of that size, they test carefully, they prepare, they position, whether that's around liquidity, tokenization, or staking. Those moves actually tend to be quite deliberate. And then there's the Goldman Sachs, right? So Goldman Sachs news around basically they've been stacking Bitcoin and Ethereum and Solana. Let me see if I can pull up that tweet. Oh yeah, there you go. It's not just Bitcoin though. It's also Ethereum, Solana, and XRP. through ETFs. So what I'm trying to say is that while price action might seem very weak right now, capital allocation at the institutional level continues to take place. Now, that does that mean that price can't go lower? Of course not. We've just spent most of this stream mapping realistic downside scenarios. Uh, but the important balance is this, right? All in all, while many of the signals we've gone through today look bleak in the short term, historically, these same zones have been incredible opportunities for accumulating, for growing your portfolio. That's not my opinion. That's what the data has shown us across prior cycles. That doesn't mean catching the bottom is easy either. Doesn't mean price won't overshoot. But what I think it means that when fear is, this elevated and these long-term structural indicators start flashing, the sort of long-term risk to reward ratio often starts improving. That's the balance. Respect the downside, definitely respect the probabilities, but also look at what history has consistently uh, showed us. And this is why it's so important not to look at price in isolation. On-chain metrics, of course, they give us probabilities. Technical levels will give us these structures, but macro developments and institutional positioning really do give us the context. Now, as analysts and traders, we have to track all of these. It may be, and most likely will be, a rocky road ahead. But while we try and manage risk, we also have to keep an eye out on what's quietly happening in the background. And this is exactly why our newsletter provides you that sort of framework. We have it linked in the bio as well. Go check it out. You'll get a clean breakout of the top stories impacting crypto without any kind of noise. And trust me, if we go lower, that noise is going to turn up. I genuinely encourage you to sign up. Staying thoroughly informed during this period is vital. I also quickly want to turn your attention to our research reports. That's why we go much deeper into the narratives that are really catching our attention. And these reports usually drop almost every week. So do keep an eye out for this. Very simple as well. Just type in Cryptopolitan reports and you'll see them. We've got a major one dropping very soon as well. It's going to be an extensive deep dive into Bitcoin's on-chain data. If you want the full structural picture, that's where you will find it. And I highly suggest you all to make use of it. All right, everyone, that's a wrap from my side for today. I just want to thank you all for tuning in. We'll be back here again next week with another market recap, more data, more context, and whatever the market has to throw at us, we'll be prepared as a community. Until then, manage risk, everyone. Stay informed, and I will see you all in the next one.